Signs the market is about to crash. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of Heise Says US. Grab your stein of coffee and let's have a look at some signs that the market is about to crash. And should we be worried? So, this is an article from Zero Hedge. We took out the June 2007 highs. The Morgan Stanley sell signal just hit an all-time high. So before we have a look through this article and look at the index, or the sell signal, let's look at the indices which are at an all-time high. Now this is the S&P 500. We can see here, I mean, there you go, guys, $4,229.89. You know, global pandemic, recession, boom. Maybe it's got something to do with expectations of more money printer go brr, government stimulus and intervention. Maybe this is where we're seeing the candle-on effect manifest in the States. You can see, look, NASDAQ as well, you know, she's hovering around the top up there, moving around a little bit, but still over 13,000. I've been watching some videos from investors back in the 90s and you know, the early 2000s, and asking, you know, do you think the NASDAQ or do you think the, you know, will hit such and such, you know, a couple thousand? Look at where we are now. Look at that. That was the big crash that we had, guys, earlier in the year, last year. Look at that. Barely even registered. And here you have the Dow Jones Industrial Average at 34,756. There you go. So the question is this signal the market timing indicator? Now this is from Morgan Stanley, and this is what they're showing here. Sell above, you know, 5 SD, and you can see here, boom, it went up. You know, there we go, and look at that fall, and then boom, it went up, and then look at that fall, 2008, and boom, it went up. Are we going to have another fall? But interestingly enough, it didn't detect that fall, did it? So, and this is an interesting one. This is where, you know, a graph showing the falls that it missed, that it didn't detect, everyone. So yeah, just keep that in mind. Or when it went above and didn't pick anything up. So these things are not perfect. But let's have a look at this article from Zero Hedge to see what they have to say about this. So, for the past several months, Morgan Stanley's fundamental analysts have been turning increasingly bearish on stocks, with the pessimistic sentiment plateauing earlier this week, when chief equity strategist Michael Wilson said there is far too much optimism in the market, and that while earnings are slowly rising, forward PE multiples are far too high and are set to slide, with the D rating about 75% to go, or an approximate 15% decline in P/Es from here. As a result, Wilson's view, which is rapidly emerging as the most bearish on Wall Street. Earnings revisions will not be able to offset the D rating, leaving the overall market vulnerable to a 10 to 15% correction over the next 6 months. It now appears that Morgan Stanley's fundamental bearishness has spilled over into the bank's technical analysis team, and as the bank's chief Euro equity strategist Matthew Garman writes, for only the fifth time in over 30 years, each of Morgan Stanley's 5 market timing indicators are giving a sell signal at the same time. Not only that, but the bank's combined market timing indicator, which has been in sell territory since March, just hit a new all-time high of 1.19, surpassing the previous record seen in June 2007, right around the time of the first great quant crash and before the market collapsed. According to Garman, the only time equities have risen after a full house sell signal was in February 17, shortly after the Shanghai Accord kicked in to prevent a global recession. The other previous occasions when there was a full house sell signal was March 90, May 92, and June 07, according to MS. In the 6 month post the initial full house sell signal, MSCI Europe has fallen on average 6%. So with every in-house risk indicator screaming sell, does that mean Morgan Stanley will have the balls to tell its clients to sell? Well, of course not. Because in this market, where stuff like the AMC, GameStop, and Bed Bath squeezes force analysts to admit they no longer have any idea what's going on. I didn't hear about the Bed Bath & Beyond. Okay. Moving to no rating, as shares are no longer trading on fundamentals. Well, there you go. Have you been following the Bed Bath & Beyond, guys? I'm not surprised. It could be another meme stock. So meme mania appears to be impacting Bed Bath & Beyond again. There we go. Morgan Stanley is keeping the hope and assuming that the current period will be similar to 2017, the only other time when a massive sell signal did not result in a market plunge. Back in 2017, we remained constructive despite the signal given. Strong EPS growth, an early cyclical environment, EU inflows, low sentiment, and a rise in M&A. Sentiment matrix may look more elevated than in 2017, but many of those factors remain in place today. While we see a trickier risk-reward for equities globally, we maintain our view that there is a compelling case for Europe to outperform global peers. Yet even Morgan Stanley is forced to admit that while defensivers may just scrape by after a record sell signal, cyclicals are about to be hammered. The next chart shows the relative performance of the cyclicals versus defensivers after a full house sell signal on. As MS notes, perhaps unsurprisingly given the poor performance at the market level, cyclicals have struggled. In the 6-month post the 4 initial full house signals, cyclicalists have underperformed defensivists on average 12%, and this dropped to negative 15% looking at any day when the MTIs have all said sell at the same time. This was true even in 2017 when equity markets rose. We previously cited similarities with the 2017 full house sell signal as reasons to not get overly cautious on equity markets in aggregate at this moment in time. Even the Feb 2017 full house sell signal, MSCI European continent, continued to rise pretty consistently throughout the rest of the year. However, despite strong performance from the market in aggregate, the performance of cyclicals versus defensivists was much poorer. Between February and June 2017, cyclicalists underperformed defensivists by 6%. It's not just the bank's sell signals that is prompting concerns about the future returns of cyclicals. Borrowing a page from our warnings, see China's credit impulse just turned negative, unleashing global deflationary shockwave. Morgan Stanley looks at a number of China data points which are giving warning signs. First and foremost, the collapse in China's credit impulse. To wit, while credit tightening has been front-loaded in 1H21, as outlined here, our economists remain constructive on China's growth recovery. Having said that, a number of Chinese data points do suggest the cyclical bounce looks overextended. China's credit impulse has just turned negative, and historically, this has provided a lead indicator for the year-on-year performance of European cyclicals. Similarly, the relative performance of cyclicals versus defensives has closely tracked moves in China's 10-year bond yields, which are now at their lowest level since September 2020, standing in sharp contrast to the performance of the cyclicalists. Putting it all together, readers has to ask themselves if what is coming will be an analogy of the one and only episode in history when the market did not plunge after all Morgan Stanley market timing indicators hit a sell, when they were at an all-time high, or will this be the case similar to March 90, May 92, or June 07, when the outcome was anything but a happy ending? So, what do you think, everyone? I mean, what's the solutions, or what's the takeaway from this? Will this influence your investment strategy? Are you investing in the stock markets? What companies are you investing in? Are you investing in things that are all-time high or things that have come off the cool? What type of sectors are you going in? At the moment, I'm looking at generating passive income, particularly from the money I'm putting in the US stock market. So I haven't noticed any of the, people have been saying, oh, the market's crashed, the market's going down. I haven't noticed it. My worst performing investment was good old Coinbase. But fortunately, I didn't put very much into that. What do you reckon, guys? Is this going to influence you? Are you worried about a sell? Or are you just waiting and watching? As always, let me know your thoughts and opinions on this one in the comments down below. If you're a fan of the channel and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can sign up for Self-Wealth or Stake. You can use our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy merch from Heise Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you in the next episode. Bye for now.